Good evening and welcome you all to this webinar session. My name is V. Kaviraj. Today we are going to talk about a new and interesting topic, which is very important also. So, before that, we would like to extend our gratitude to the members who have joined this webinar and for giving your valuable support so far being as a participant. Thank you so much. I hope that you would have received a message from our office through WhatsApp about the today's agenda. Yes. Okay. Before that, let us have a quick introduction about that who we are. We are consulting and beyond one of the leading financial advisory and management consultant based out in Chennai. We have 25 plus years of experience in various kinds of industries to offer our clients. So our ambition is to increase the sales and maximize the shareholders' wealth by increasing the profit. This is our vision to succeed. So we have created a four business verticals, namely audit and assurance. Being an auditor, we have to get assurance on the financial statement, whether that is free from material misstatement and free from errors and frauds. And the second one is tax advisory. So we file income tax returns, GST returns, namely GSTR 1 and 3B on monthly basis. Moreover, we file GSTR 9 and 9C after the financial audit ends. We also go deep about the taxation point, exactly tax issues. We handle income tax notice and GST notice. We give the final solution to our clients. And the third one is management consulting. So in that, we normally focus on giving all kinds of strategies and studies. We enhance the business to move further. This is for managing consulting. Normally we do that. And fourth one is corporate finance. In this, normally we help our client to get all the bank loans in a satisfactory level. We help them in the banker norms also. So these are the four business verticals that we have created to get succeed based upon the vision that I said earlier, that to maximize the shareholders' wealth by increasing the sales and the profit. Now, I would like to thank our founder, Mr. Umesh Gulacha sir, and Ratandeep madam, and I mentor Mr. Arun Chalamuthu, and so on. So thank you for this opportunity to everyone that we given. Yes, and this myself, Mr. Kaviraj, team lead, and Stephanie, analyst, and Shrinity, analyst. They're going to conduct the next slides and all. Now, today, the focus area is that the five major things. The number one is major changes in ITR forms and pre-filling health checks of financial informations, mistakes that attract tax scrutiny, common missed deductions, reconciliation with government records. So these are the four focuses area on today. So now first one, let us see that major ITR changes forms. So before that, I would like to say the due date has been extended from July 31st to 15th of September. Could you please just let me know that what is the reason behind that? That is due to the major ITR changes. So now it has been released recently. Now let us see one by one how many forms have been changed and what all the changes has been done, whether that will be more advantageous to the assessee or the clients at the time of filing or what else. Let's go one by one. So first one, so you all know about what are the numbers of ITR form that has to be filed by all individual HUF and companies on. Anyhow, let me explain that. ITR 1 is for all individuals with the income, salaries, and house property, one single house property, and any other income, including capital gains, provided that should be within the limit of the exemption of rupees 1.25 lakhs. That comes under ITR 1. And for ITR 2, the same assessee having more than one house property, that will come under ITR 2. And for ITR 3, for all individuals having business incomes, comes under ITR 3. And next is ITR 4 is the same, applies similar to the ITR 3. What is the difference between this 3 and 4 is that presumptive taxation will take place here. In ITR 4, normally you know that the section 4480 and ADA will take picture. In 4480, normally the income has to be offered a minimum of 8%. For them, ITR 4 is applied. Other than that, ITR 3 will apply. I hope that will be clear for you. Now, ITR 5, that applies for partnership firm and LLPs. And for ITR 6 and companies. And ITR 7 is for trust. So these are the ITRs total. So I request all of your clients to go through it once from ITR 1 to 7 and check to which ITR is applicable, and accordingly you can file it, or else complications will be there. I hope it will be so far so good. Now let us go with the mandatory declaration of tax choice. So this applies to all individual HUF taxpayers filing at year 1, 2, 3, or 4 must now has to declare whether which option is beneficial. The client has to check on their own which option is beneficial, whether new tax regime is beneficial or old. Still choice is available. So in ITR reportedly, now they include a specific section whether opting for this new and old section. That is section 115 BAC. Default, it will be new regime. So once you log into the ITR portal, and if you start filling your income tax return, when you click, automatically it will be default in new regime. And you have to ensure yourself at the time itself whether new will be beneficial or old. If yes, you can go and proceed with that. If not, you have to click on the no and continue with the old regime. Provided in old regime, you will be allowed for all the deduction under Chapter 6A, that is 80C, 80D, and so on. But in new regime, there won't be any deduction at all. But in old regime, you have to submit all your proof. Like, let us take an example that if you are claiming an LIC under 80C, then you have to provide your receipt, LIC policy number, etc. Earlier it was not there, but now it has been updated. So you have to fill all those things if you selected old regime. If not, you cannot claim deduction. Please ensure that. Now, who can switch over from old to new, new to old? Whether all the assessee or is there any selected assessee? Let's check. The taxpayers, only salary income. So salary income assessee can switch on from old to new, new to old. There won't be any separate formalities or form is required to be filed at the time of filing income tax returns. But this is not applied for business and professional income. They cannot switch. They can switch only once from old to new or new to old, provided they have to fill Form 10 IEA. Let's take an example. For the year under 2024, they filed an income tax return by the business or profession under the old regime by filing 10 IEA in the year under 24. Still, they are opting for the old regime in the new financial year, that is for 24 and 25, which they're supposed to be filed. Whether the Form 10 IEA is required to be filled? No, because at the time of year ending 2024, they already existing in the old regime. They already filed the Form 10 IEA. Still, they are going to continue with the old regime, and it's not mandatory they have to fill the Form 10 IEA. But suppose if the same assessee would like to go into the new regime, which is beneficial, let us assume, then they are switching from old to new. They have to fill Form 10EA mandatorily. This is for the updation in new ITR. Please ensure before selecting the old and new. Now, let us go in deep about the changes done in ITR 3. In ITR 3, what was the earlier provisions and what was the latest provision? Let's see. In Part A schedule, earlier there were a redundancy data were there. The gross updation of gross profit, net profit, sales, everything. Redundant data means, let's take an example that if you fill a sales, a purchase figure in one particular column, and if it is required to be filled in some other column, you have to mandatorily, you have to go and enter it. In this, typo error may happen, oversight, it may happen. So error may also apply. But now in the latest form, it's not necessary. Once you put a sales or purchase figure anywhere else in the beginning itself, if it is required to be updated in anywhere else in the return in the next subsequent forms, it automatically takes out from the first form. So this is called an auto-populate figures. And the gross profit and the net profit also, it will be auto-populate. Earlier, it was not there. This was the updation in the Part A schedule. Now let us go into the business code. So previously, when you fill a form, the business code has to be updated. Let's take an example of 5-digit or 6-digit. Earlier, if you know the digit has to be updated, even if it is incorrect, it will be taken by the website. But you have to give the 5-digit. But now that 5-digit also will be mapped according with the latest CBDT format. Even if you incorrectly type, though it is a 5-digit, it will be throughout an error message that is incorrect. So this is for the updation. When we get into the capital gain, earlier, the capital gain report has to be done on the profit or loss arises based upon the asset-wise classification, equity-oriented or debt-oriented, or what is the nature of asset, and everything has to be updated. Now, including that, you have to do a bifurcation based upon the sale date. The date is before July or after July. So this date also required apart from this. And the short term, let's take an example. Thus, if you an assessee sold a listed shares, which becomes a short term. If you sold it is 31st of July before, the charge will be 15% on tax, or else it is 20. So this is what the Again, this is the updation. Next one is balance sheet. When you come to balance sheet and P&L account, earlier manual entries would be there. So manual assets and liability has to be accounted based upon your finalized balance sheet. Again, typo error may happen. So now it is a common classification ledger would be there. Whatever the ledgers or whatever the account that you create, the one common ledger would be available at the ITR portal. You have to sum up everything, you have to do it. So manual error would be avoided. When you get into the fixed asset of the depreciation, there won't be any format earlier. The updation what you are doing is depends upon the user discretion. If suppose the user need it exactly, then they have to give all opening balance, closing balance, or if they could use only giving the closing balance. And now it's mandatory to all the associates who are having a fixed asset. They have to give all the opening balances and addition, deletion, if any, and the closing balances, depreciation, everything. So to have a clear picture, what are the type of asset the assessee have, and the depreciation show on whether they calculated correctly or not. So all sort of things has to be given exactly now. And when you talk about the closing stock, there is inventory. There won't be any connection between the trading and profit and loss. You all know about whatever the closing balance which is unsold during the end of the financial year, that has to be updated, and the same has to be shown in the asset side. This is a manual entry would be there earlier, but now it's an auto populate. Automatically, whatever the value that the figure enter, automatically it pops up into the current assets of the balance sheet. So in ITR 3, these are all the changes were there. When you talk about ITR 5, the same. The general information is the same. This applies for all partnership firm and LLP, as I told you earlier. So all basic information has to be given, including auditor's detail and SEBI registration if applicable. This is the one updation has been given by the department. And to whom it is eligible, to all type of firms, LLPs, association of person, body of individual, everything is applied. Okay. So then the latest thing is what same it is applied and understanding the new section to the confirm its correct usage of the form. So granular sections has been implemented and lot of conditions were there. Okay. Then if suppose the LLP or the firm has an international transaction, then you have to get a certificate. There is a legal entity identifier. So this has to be obtained and reported exactly. Next, the audit information. So section 44AB talks about normally the audit cases. So earlier it talks about only 44AB. Now it also includes all GST returns and to cost audit if applicable. All the dates has to be given. So exactly. Now, next one is the buyback of shares. If there are any shares bought back, what are the effect? Earlier there were no specific provisions available, but now buyback of shares is also available. Provided if any suppose loss arises due to this buyback, then loss can be set off. But earlier there were no provisions. If suppose loss has to be set off in the current national, that is the latest ITR5, then you have to give all the details of the particular shares, which is if you receive any dividend, you have to disclose. This took effect from 1st October 2024. So please ensure if you bought back any shares from any companies, ensure that you show the dividend in IFOS column, that is income from other sources column, so that the loss will be set off carry forward. When you talk about the ATG option, you all know there is donation. So detailed description was not there earlier, but now you have to give all the donor PAN, donor name, and the mode of payment for ATG to claim ATG. This is what the latest updation in ITR 5. Okay. When we talk about the ITR 6 applicability, let's see the applicability first. So it is applied only to the companies. As we discussed earlier about from ITR 1 to 7, this is applied to only companies, excluding exemption under section 11, which normally the companies comes under charitable trust or registered under section 12A or 12AB, you know that income tax solution. So apart from this is applied to all the companies. Okay, what are the schedules? Now schedule G, shareholding pattern has to be given. So all the PAN number and the shareholding pattern and shareholder's name has to be given earlier, but now there is only one change. Same is applied. PAN number has to be given. All shareholding pattern has to be given, provided all the movement of shares also to be given. Movement means opening balance of the shares bought in the particular financial year, plus additions if any sold during the year, and closing balance. Same as fixed asset like what you have seen earlier. It applies opening balances, addition, deletion, and closing balance, including face issue also to be given. Next, if suppose the same associate bought any foreign shares from foreign companies, the foreign bank account also to be given, to be accomplished again. So this immovable properties, if any shares, any foreign shares has to be given. Next, When you come across the CSG or CSR, well, corporate social responsibility and all. So if suppose any company is engaged with this social activities, then they have to get a report and to submit the report for the activities such conducted by the company at the end of financial year. Audit trail enhancement. So minimum leakage. Earlier, the minimal linkage would be there, but now the stronger linkage would be there because automatically, what I told you is that this is mainly an auto-populate. So wherever you fill the value, automatically wherever it comes in the future, it has to be taken automatically. So ensure that you fill the correct figure. Asset and liability reporting, there was a standard method of asset disclosure earlier. Now this more granularity has become. So what type of asset, whether it's an intangible or tangible, current asset or long-term asset, this classification has to be given. So simple as that. The updation of ITR form is nothing but, and still elaboration is there. Then a lot of updation has to be given in that ITR, new ITR forms. Now let us see about what are all the advantages in the revised form. Is it beneficial or not? Maybe still many things has to be covered, like entering an asset, like fixed asset, all detailing has to be given, like purchase of an asset, opening balances, any deletions, if any, has to be given. So will it be really an advantage? Yes. Why? Because this allows the auto cross verification. Let's take an example. If you file income tax return by showing the turnover so-and-so, but normally we file GST return on monthly basis by filing GSTR 1 and 3B. So the value that is the turnover value that is shown in GSTR 1 and 3B should match the value which is shown in the income tax return. If there are any mismatch, again complication will come. To avoid this complication, they have given a structured manner where it allows an auto cross verification. If you enter a misfigure while filing the income tax return by showing an incorrect sale, this automatically goes and checked with the return that you filed on monthly basis. If it is not correct, automatically it throws an error. You will go and recheck it once again before filing it. So this will be very, very, very good, and it will be more advantage. Let us take the what are all the advantages that furthermore on that. Next one is annual information system and annual information statement and form 26A. The same. If suppose if are getting a bank interest or any other interest under section 194A or 194H, whatever it may be, if any TDS has been deducted, automatically that will be notified by the income tax department through your PAN number. And you have to take into consideration about that. Even if you omit it, automatically you will be issued a notice. So this is all auto cross verification that has been implemented. The main benefit of this auto cross verification is that it reduces the mismatch notices. If suppose there is any deviation between GSTR 1 or 3B, and if there is no deviation between GSTR 1 and 3B, but a deviation between the ITR report, if any deviation happens, automatically your notice will be thrown by the assessee to you. This will be avoided in future because at the time of filing your return, you have to go and reconcile each and everything like an homework that you have to reconcile the GSTR 1 with 3B and 3B with your income tax return, like whatever the income that has been popped up in the income tax website, you have to take into consideration whether you have paid the TDS or not, and whatever the advance tax that you paid, that automatically will be taken care by the portal. You have to check whether we are claiming it the same. So all are beneficial. Then notice will be reduced at your end itself. And it promotes end-to-end transparency. Yes, it's a transparent data because whatever income that you receive, automatically that will be notified by the income tax department. They will raise a question if there is any income is shown less. It automatically prevents accidental, deliberate under-reporting income, of course. Now, this is improved taxpayer classification and reporting. So the very big advantage is that your income has to be segregated on head base. You know that 5 heads of income is there: salary, house property, capital gain, and income from other sources. These are the 5 heads. You have to segregate accordingly as per the classification given by the income tax report. I mean ITR forms. The benefit of this, is that enable tailored scrutiny, and the professional, the rest of the auditors have to prepare the client specification documents before filing, and it will be useful for all internal audit and the tax planning matters. To avoid this thing, you can use the software called Tally, Excel, or whatever it may be. It should be an advanced one. It will give an exact TB, which is corrected one, and also give the supporting schedule also. This will be very good to the MSME to use this opportunity to improve their financial hygiene and digital traceability also. So this is very good thing. Now, let us go into this mandatory schedule of GST. The advantage is that increase the need of reconciliation before filing. As I told you earlier, you have to go for reconciliation with GSTR 1, 3B, including 9 and 9C also. So it will be good. Otherwise, maybe the complications would be there. By you may receive a notice in future if there's any deviation happens in your return itself. Then it will prevent the dual reporting and the tax-based leakage also. Dual reporting means you know that. Okay. Audit firm can also now use this as a pre-audit analysis. Exactly. We also, even though if client does that, what all the reconciliation, we also do at from our end, whether the reconciliation were done by the client is correct or not. If not, we will guide the client to perform once again, or we perform on their behalf and we file the return safer side. If suppose whatever the information that I have given so far with regard to the ITR forms, if suppose any client or clients fails to adopt this rules and regulations, what would be the consequences they have to face? Is that simple non-compliances? They may issue a notice initially, then it will be then penalty will be there, interest charges will be there. Exactly, they have to incur all sort of expenses. To avoid this one, you just go through all the ITRs from 1 to 7, and what all that I've spoken right now, you just go through it, analyze before filing, check it, and do reconciliation for GST 1 and 3B with your income tax report. I hope that so far what I've taken is that clear, and you hope that you've understood everything. Let us have a quick poll, whether this analysis, how far that you've understood and all. So, can you claim tax deduction without submitting any certificate or proof? Please analyze about that what we have discussed, and please answer that. So I think the answers are coming very quickly. I hope this could be easy one or not. Okay, so the answer is no. So most of you have answered exactly that. I hope I'm very happy that you've understood the session that so far that I have taken. So you have to submit all the proof if you're getting into the old regime for deductions under section 80C and D, like LIC receipts and policy documents that you have to submit. So I hope everything is okay. Now the session will be handed over to Ms. Shrinity, and she's going to take care with the next slides. And thank you for watching this one. Please speak.
Thank you, sir. Continuing on the path of compliance and accuracy, we will be taking you to the next important phase of ensuring financial documentation and ledger verification and reconciliation. This pre-filing health check of your business finance will help you to prevent notices, mismatches, and ensure you to claim what has missed before, be it a deduction or an exemption. Now let's start with pre-filing health check for your business finance. First of all, what is a business finance? Metaphorically, business finance is all about the lifeblood of a business. It helps you to ensure smooth flow of operations, and it shall also be ensuring you optimum utilization of resources. Because if there is going to be too much of resources, it leads to wastage. And if there is a shortage in resource, it will lead to disruption in the business activities. So you have to make sure that business activities are done without any disruption by having an optimum flow. Now let's have a quick uh, discussion on what is pre-filing health check and why does it matter a lot. This pre-filing health check is like a body checkup which you do, which will help you to identify if you have any disease or you're staying healthy throughout, right? So that's how health check is all about. So here, in case of pre-filing health check, it will help you to avoid notices and penalties because it helps in identifying errors, non-compliance prior to submission. It will also help you to ensure accurate filing in order to reflect the true states of the business. About filing of audit, it makes the audit go smooth by organizing data and properly classify the resources, properly classify the accounts history. Now let's have a deep dive into bookkeeping and accuracy. I request people to mute. Right, let's get into it. Bookkeeping and accuracy, which creates a foundation for accurate and clear maintenance of books of accounts. This bookkeeping and accuracy will also help you to correctly report your financial transactions and reconcile the books. It will also help you to properly classify expenses and incomes under correct head. For example, if you try to classify your expense of a recurring nature to a non-recurring one, it may impact the financial statements in the long run, and it will also have a huge adverse impact too. We don't want that, right? So that's how we have to be careful and vigilant throughout the filing as well as maintaining books of accounts. Now, it will also help you to clear the suspense. From the first, you'll have to maintain books of accounts in such a way that you maintain a narration for each and every transactions which you're noting down. So this will automatically help you not maintain any suspense at the year end. Some of the tools which you could use for proper bookkeeping and accuracy maintaining was the Tally or Excel, because this will help you to maintain overall financial health of the organization. Now let's have a quick question. Right. Which of the following do you regularly use for reconciling cash and bank balances? Is it bank statements, cash book or bank ledger, bank reconciliation statements, proof of deposits, cash deposit slip, or all of these? Yeah, I'm getting response from you guys. Okay. Seems like majority of people chose all of these over here. Like about 55% of people have chosen all of these, which is the right answer. It's not that others were incorrect, the other 45%. It's just that you might have thought from your point of view, like from the particular account alone. But it's the actual answer is all of these, since all of the documents out there are important. So I am here to give a brief explanation on why all of these documents are important. Now, bank statements. Bank statement is something which has been received from a third party, that is bank institution. So this bank statement is what you will be having in order to verify your books of accounts. Whatsoever you are recording day to day, you will be verifying it with bank and reconcile accordingly. About cash book and ledger, this will help you to have a daily track on all the cash and bank activities within the company, so that you will also be able to maintain a clean book of accounts. The bank reconciliation statement, it helps to bridge the gap between companies' records and the bank balance which you have got from the banks of financial institutions. And about the proof of deposits, this will help you to have this is a physical document which you could have uh, as an evidence to confirm that the funds are physically deposited into the bank. Now let's talk about the reconciliation of bank and cash balances. You need to ensure that no income or expenses has been missed out, be it something so be it, be it something small or so significant for your company. It is very important to disclose it in order to avoid attracting notices in the end. Secondly, you have to ensure that whatsoever cash in hand you're maintaining physically shall have to be reconciled with the petty cash ledger which you are maintaining, be it in a Tally or Excel. Try to match it out. Next, you have to verify the nature of incoming funds. You need to, like, this verification is important because this will actually help you to hold on where to park your funds properly. Now, there is a comprehensive review of financial statements, which we are going to see right now. For this, you need to properly analyze the position statements and the income statements. Also, it is very important to analyze your cash flow statements too, because this will automatically help you to ensure transparency, completeness, and accuracy. This comprehensive review of financial statement is not is not just to review it in detail, but it will also help you to maintain financial health and to scrutinize all the incomes and expenses in the long run, because scrutinizing incomes and expenses will be very helpful for decision making, be it business expansion or be it for any other kind of diversification matters. If it is going to be a financial planning like budgeting and stuffs, again scrutinizing incomes and expenses will be so much helpful for you. And this comprehensive review will also be helpful in order to comply with the tax laws and to maintain accuracy at the end. It is also very important to calculate depreciation as per both IT Act and Companies Act, because Companies Act is what we will be reflecting in the books of accounts and IT Act is what we will be reflecting in the statement of taxable income. Both are important to be noted in such a way that it will not just ensure a proper calculation, but it will also ensure proper disclosure too. Now let's get into ledger verification. So about ledger verification, right? You need to focus on some of the areas. What are they? Be it current liabilities or assets like sundry creditors or debtors. In case of sundry creditors or debtors, right, there is an analysis known as aging. So aging is something which you guys might have known, especially people from audit department might have been doing your aging analysis, right? So aging analysis is nothing but categorizing your creditors and debtors as recovered or settled, unpaid, or overdue. So this shall be helpful in order to settle the creditors at the earliest, or in case of debtors, if they are failing to settle you within the due date, it is very important for you. It is very important for you to create a provision accordingly. Next thing you have to notice is the related party transactions. It is very important to disclose the related party transactions. Why? Because all those related party transactions may not be happening on the arm's length price. Why? Because obviously they are someone who is related to me. I'll be always trying to reduce the income. Like if I wanted to sell a product at rupees 100, but I'm for a related party, I'll be doing it for only 80 rupees. So I am reducing the income and reflecting the same in my books of accounts. Just make sure that you are going to disclose such type of transactions so that people will not be having any suspicion about you if you're going to constantly reduce your income and show it accordingly. Next comes the TDS deposit and proper entry. That is, you have to properly deposit your TDS within the due date of filing it. Like payment of TDS happens every 7th of next month, right? And filing of return for happens quarterly, like the 30th of next. Like for example, for a first quarter of April, May, and June, you will be filing it within July 31. So that's how you have to make sure that you do everything correctly. You have to make a proper entry too. Proper entry of TDS deposit is nothing but whatsoever amount you have deposited as a TDS and remitted it to the government, you have to make sure to record the same transaction in the same date in the books of accounts in order to maintain a double entry system as well as a clean track on the transactions. And now it is so important to have a clear narration for each transactions you are making, again because this will help you to park your incomes or expenses under the correct head, and again you will be able to calculate statement of taxable income and present it accordingly. Now, what are the supporting document checklists you have? This supporting document checklist is nothing but a list of documents which you will be maintaining to ensure validation of financial entries to facilitate smoother processes. It will also ensure the readiness of audits and filings. What are they? Be it sales invoices. Sales invoice, whatsoever sales you have made, you will be getting an original invoice, right? So you have to reconcile that original invoice with your GSTR1. Original invoice is what we get, and we will be automatically recording it in our books of accounts. You have to make sure that your books of accounts is getting tallied with GSTR1. Next comes the expense vouchers. Expense voucher is all about cash and bank payments, which has to be recorded properly. Then comes the agreements. In case of agreements, written agreements are much more effective when compared to oral agreements, because they will give you a proof in case of disputes that might be happening in future, be it a loan agreement or a rent deed. Next comes the depreciation chart. You have different blocks of assets, right? You'll have a block of 10%, block of 40%. So based on the type of asset, you need to park it under the respective blocks in order to calculate depreciation. Again, in order to calculate income as a whole, because calculation of correct depreciation will help you to correctly park it as an expense for your books of accounts when compared to income. Next comes the loan statements. When it is all about loan statements, right, you have to make sure what are the outstanding loans and advances which might be pending from your side, or if you are not if you have not settled any loans and advances, like any loans at the year end, you have to update the same in the books of accounts, in the financial statements. Next comes the stock valuation certificate. This stock valuation certificate shall be very helpful for inventory calculation, right? Especially the closing stock values, because closing stock will automatically affect the profit calculation. Again, profit calculation will also affect the income as a whole. So you need to make sure that you have a correct evidence to say that, yeah, this is my stock. This is what the value when any third party comes and inspects you, which is nothing but the department. This stock valuation certificate will also be helpful for demanding working capital loan. That is loan which you could do for your day-to-day activities, right? The current loan which you might be taking. So it will be very helpful for it. And now let's move on to the next topic of final review. This final review is nothing but a total summary of what I have said before. Final review is like what are the tools we might have used before, be it Tally or Excel, right? So this Tally has its own inbuilt features like verification of vouchers, which will help you to verify the different ledgers. And there is an exception report which might be popped up in case of a Tally too, which will help you to identify negative stock. Because if a stock is being negative, then that is a red flag. We have to notice why is it being negative. You have to ask the organization for the same. So make sure to use these kind of benefits which has been produced by Tally. In case of Excel, you could have a lot of formulas or conditional formatting be used in case of negative cash balances too. So when cash goes negative, you can also ask the same to the particular party, or you can check by yourself why is it being negative. Now the error pops up, or a red color pops up when there is a conditional format used for the particular cell. So you can be able to understand it. There is a checklist recap. Generally, this financial statements have to be made according to Form 3CD, which is a statement of financial statements again, which will also give you related disclosures. This Form 3CD might be filed along with Form 3CA and 3CB. 3CA is applicable for all those companies or insurance companies because they have been already like following another laws, right? For companies, it is companies law. For insurance companies, it is IRDA Act. For banks, it is Banking Regulation Act. So such type of organizations will have to file their financial statements in Form 3CD, and they have to file Form 3CA too. Now, for people like us, be it individuals or like firms, HUFs, you have to file your statements with Form 3CD as well as 3CB. You have to make sure to file everything correctly. Just because you try to disclose your income, right, doesn't mean that you have to pay tax. There are eligible exemptions or deductions available, so you can make use of it. It's just that you're going to disclose it and you're going to stay vigilant. Again, you're going to stay out of the radars which might be happening or affecting you in future. Now, let's move on to the next topic, which is of staying off from the radar, that is smart tax filing strategies. Now, why do you think tax notices occur? Tax notices generally occur because of some of the following things, be it data mismatches. Data mismatches might be happening when you try to reconcile your books of accounts with what have been actually reflected in the IT portal, right? For example, if you try to park your TDS kind of transaction under different sources, in future, if you want to file a refund, it will not be possible. Like the refund may be coming late. So you have to make sure to file it properly in such a way that it is not going to it is going to avoid any discrepancies in future. Next comes the missing income disclosure. As we have said before, the income which might be a small one or a significant one, you have to disclose it properly in order to avoid any uh, in order to avoid any disputes or avoid the notices, be it high value transactions. Now, this high value transaction is nothing but, now generally your normal course of business, you're spending an amount of 50,000 probably. Now, what if suddenly your transaction amounts to 10 lakh or 30 lakhs? Now, that is going to be a red flag. It's not a red flag, but yeah, that is going to be something which you have to stay focused on. You have to stay vigilant to say that why it has been happening, because government has a track on you. You have to stay vigilant and you have to properly disclose each and everything. And it is better to file before the due date, because during the filing some mistakes might be happening, right? These are inevitable in nature, so you have to make sure that these filing has been happening within the time. Like if you even try to file it wrong, you still have ample of time. You can file it before, you can rectify it and do it again. So make sure to file beforehand in order to avoid any problems. Now, some of the common filing mistakes which you might be having is the false deductions. Now you have claimed HRA, but you have your house on your own. You cannot do it. You are falsely claiming deduction and showing your income as a low thing, which is bad. So don't do it. Second is the incorrect bank details, be it a incorrect IFSC code or incorrect bank number, which may delay the fund transaction. So make sure to give the proper filing in order to not disrupt the activities which you're undertaking. Next comes the TDS part. Again, as I've said before, you should not ignore TDS, because government knows what type of transactions you're engaged with. They know what kind of transactions will attract TDS. They have it, right? So you have to make sure that you're going to part the same thing in your books of accounts, as well as check it with the portal. When it comes to unverified income tax return, that is nothing but once after you have filed your income tax return, now it's your duty to e-verify it, either using DSC or EVC. Like DSC is nothing but signature certificate, and EVC is nothing but the OTP kind of transaction. So you have to make sure to do it beforehand, because sometimes when you're going to e-verify it, right? It was 120 days before, like once after your file, government has given 120 days time period before to e-verify it, but now it has reduced it to 30 days. So within 30 days, you need to e-verify. Otherwise, your verification, that is the ITR filing, might be turned as an invalid thing. And again, you have to do from the beginning, which will waste your time as well as effect. So don't do it. Next comes the essential guidance, which is available for business or professionals. So you have to maintain proper books of accounts. Again, you have to make sure to report the cash expenses correctly. What are the cash expenses? Like, for example, in case of threshold limit, like there is a cash payment, right, of only 10,000. So if it exceeds, you need to make sure to disclose it properly and try to avoid those cash expenses and have it to 10,000 only. And try to disclose the clear cut of turnover and profit reporting properly in order to avoid any discrepancies. GST reconciliation has to be made with the sales, purchases, as well as whatsoever input you're going to claim in future, like reconcile it with GSCR 2B. Thank you so much again. Now the session is over to Stephanie.
Thank you, Shrinity. Now let's see what are the common deductions that we are missing to avail as deductions. First is depreciation. Depreciation is a fundamental deduction allowing businesses to recover the cost of its asset over its useful life. Proper calculation of depreciation is essential for maximizing this benefit. Depreciation applies to assets held in use in business or profession. Assets include tangible and intangible assets. Full depreciation is charged for assets that are put to use for more than 180 days, that is before September. 50% of depreciation is charged for assets that are put to use less than 180 days in the year of its purchase. Charging of depreciation reduces asset value and can claim as reduction from income. Now let's see the depreciation rate. Depreciation rate for buildings are charged at 10%, for plant and machinery at 15%, for computers and software at 40%, furniture and fittings at 10%, and for intangible asset for 25%. Further, businesses engaged in manufacturing can claim additional 20% depreciation on new plant and machinery, provided the new plant and machinery should be used for the purpose of manufacturing or production of any article or thing. Where the new plant and machinery is used for less than 180 days, then 50% of depreciation is charged. That is, 10% is available on the year of its purchase, and the remaining 50% is available in the next year. And no further additional depreciation is provided when plant and machinery are used by any other person in India or outside India before its installation, or when it is installed in office premises or any residential accommodation, including a guest house, or any office appliances or road transport vehicles, or when plant and machinery's cost is fully allowed as deduction in any of the previous year. Additionally, the additional depreciation can be availed only by assessees opting for old tax regime. Do you know any initial business cost can be deducted over time? Yes, Section 35D allows for amortization of preliminary expenses incurred before your business officially begins its operation. What are preliminary expenses? Preliminary expenses include preparation of feasible report, project report, legal charges for drafting or printing of MOA and AOA, company incorporation fees, or cost incurred for issuance of shares or debentures of the company, being underwriting commission or brokerages, and charges for drafting or advertisement of the prospects. The maximum limit of depreciation is actual expenditure incurred or higher of 5% of the project or cost of capital employed of the company, whichever is lower. And this deduction can be claimed in 5 equal installments, that is in 5 subsequent financial years. And this deduction can be applies only for Indian companies and resident non-cooperative associates. Now let's understand this with the help of an example. ABC Limited incurred rupees 7,000 as an incorporation expense, and its paid up capital is 1 lakh rupees. And its actual cost of fixed assets lying in the balance sheet as on the last date of the previous year in which the business commenced is rupees 1 lakh rupees. Now let's calculate the maximum reduction. First is actual expenditure, that is 7,000 rupees. 5% of fixed cost, that is 5% on 1,50,000, that is 7,500, or 5% of paid up share capital, that is 5% on 1 lakh, that is 7,000. For part B, the higher of 5% calculation is 7,500. So maximum reduction allowed is lower of 7,000 or 7,500, which is 7,000. Can lapsed ITC be claimed as business expense? Yes, in many cases, lapsed or ineligible ITC can be treated as business expenditure. What is lapsed ITC? Lapsed ITC is nothing but ITC that couldn't be claimed due to non-compliance, time bar, supplier not registered GST returns, or disallowed in assessment, or pertains to block credits. If GST paid becomes your cost due to ITC lapse, GST paid on ineligible supplies can be added to your business expenditure, provided the underlying goods or services are used for businesses, which is not, and that shouldn't be in the capital in nature and not legally prohibited on deduction. Section 34D, certain deduction to be Section 34B, certain deduction to be made only on actual payment. Section 34B specifies that certain deductions are allowed only on actual payment, irrespective of the amount, irrespective of the method of accounting is followed. Such payment includes any sum payable by way of tax, duty, or cess, any sum payable as an interest or loan or borrowing to public financial institution or state financial corporation, or bonus or commission payable to employees. For the purpose of claiming this deduction in the relevant year of purchase, the payment have to be paid on or before due date of filing ITR. If such payment is not made within the due date of filing ITR, then such amount cannot be claimed as deduction in the current year. Now let's have a quick poll based on this. Okay. The question is, I hope the poll is popping on your screen. Okay. Employees' contribution to PF or EIS is allowed as deduction under 44B only if it's paid on or before 31st March or due date of deposit under respective law or due date of filing ITR or end of the financial year. Most of them have answered correctly, that is due date of deposit under respective law. If employer contribution to EPF or ESI is paid after the due date of deposit under respective law, the payment is disallowed under section 43. It is allowed only when it is paid on or before the due date of respective law, that is as per section 36. Let's move on to next deduction. General business expense. Many day-to-day operations are fully deductible. Ensure that those expenses are properly classified and documented in your books of accounts. Those general expenses are not covered under specific sections like salary, rent, interest, depreciation, etc., but are necessary and incurred during the normal course of business, and that are not personal, not capital, and not prohibited by law. Those expenses include business insurance, bank charges and processing fees, domain name and hosting charges, but does not include CSR activities, penalty for breaking the law, personal expenses, donation and gift to politicians, capital expenditure except for depreciation. Reconciliation of government records. As mentioned earlier in the session, we understood the importance of reconciliation of government records with the books of accounts. Now let's see what are the government records and with what we have to reconcile. First, Form 26AS and AIS. Form 26AS is nothing but tax credit statement that shows tax deposited and deducted, advance tax and self-assessment tax paid, high-value transactions like purchase of mutual funds, purchase of foreign currencies, investment in term deposit, and refund issued by the IT department. Now, these components should be matched with your books of accounts like TDS ledgers, advance accounts, advance tax entries, income declared in ITR. And next is AIS. AIS is nothing but annual information statement that shows interest income from savings bank, term deposit, dividend, stock trades, mutual funds, foreign remittance, and property transactions like purchase and sale of assets. Match these income with the books of accounts under respective heads like other income, interest, capital gains, dividend records, and with the assets. Match your 26 years and AIS with your books of account and file your ITR. Because from financial year 21-22, AIS is used as evidence of undeclared income and mismatch can lead to automatic complaints notices. Next is TDS certificate. TDS certificate that are Form 16 and 16A are issued by deductors. Form 16 declares TDS on salary and 16A declares other than TDS on salary, that is TDS on contract, interest, professional, etc. Match these amount with the amount recorded as income in the financials, TDS receivable in the financial statements, and with the Form 26AS entries. Next, let's move on. GST returns, that is GSTR 1, 2B, and 3B. Ensure that the sales reported in GSTR 1 matches with those reported in GSTR 3B. Reconcile the sale reported in GSTR 1 and 3B with the turnover with reported in your books of accounts. Verify that the ITC claimed in 3B does not exceed the ITC available in GSTR 2B. Also, claiming excess ITC beyond what is reflected in GSTR 2B may lead to GST notice and potential scrutiny. Ensure that every transaction reported in GSTR 2B is accurately accounted in your books of accounts. While reconciling, we may come across certain mismatches. Now let's see what are those mismatches and how to overcome those. First, income shown in AIS but not in books. Interest income, that is FD interest, savings bank interest are auto-reported in AIS, but we may omit to record those in their books of account. So we have to cross-verify AIS with the bank statement and record those income in the books, even if TDS is not deducted. Next, TDS deducted but not claimed in return. We may forget to claim TDS in ITR, especially from interest or professional income. Reconcile 26 AS with books and ensure TDS schedules are fully filled. Next, TDS claim but not reflected in 26 years. The deductor may fail to deposit TDS or file TDS with the incorrect PAN. Communicate with the deductor to revise TDS return. Also avoid claiming TDS until it is reflected in 26 years. Mismatch due to PAN or TAN errors. This may occur because the deductor may wrongly quote TDS or a PAN or TAN. This may lead to credit not appearing in 26 years. Ask the deductor to correct and refile the return and retain all correspondence as support. Next, sales higher in GSTR 3B than ITR. This happens because the credit notes are not adjusted in ITR and GST returns may show gross turnover including taxes. For this, reconcile gross sales to net sales, ensure adjustment of credit note return and discounts are made. Purchase shown in ITR but not in GST. This happens because the books contain non-GST purchases and GST not claimed on eligible purchases. Maintain complete purchase ledger and do not rely only on GSTR portal. Reconcile with the GSTR 2B. ITC claim in GST not matching with books. This may happen because of wrong accounting entries or when invoices are not properly recorded in your books of accounts. Match GSTR 2B with the books of accounts. Also ensure timing booking of all GST invoices. With this, we conclude this session, and I hope now you have a clear understanding of who should file which ITR form, what are the mandatory disclosures required by filing your ITR return, pre-filing health check to perform, how to file your ITR accurately and avoid common errors, deductions that you can claim, and how to reconcile government records with your books of account. Don't file blind just because it's your obligation. File smart, file right, and save more. If you have any doubts from this session, please drop this in the comment box. If you have any doubts or queries from the session, please drop that in the comment box. If you have any further queries related to tax, drop a mail to taxation@cnb.in.
Thanks for watching this webinar, and we have a few questions just to be answered. Ari sir, thank you for watching this, sir, and very shortly that we will send you the PowerPoint presentation through your email ID, and you can drop you any questions right now if you have, and I can. So there is a question that's been given by the participant: which person can file ITR 3? So this applies to all individual and HUF for doing business or professions apart from this 44 AD section, presumptive taxation. So they cannot file, other than we can file.